All right, class. We've been talking about the Fed for the last couple of weeks, and I've showed you some videos about the Fed. And so I wanted to just mention some more things about the Fed to finally conclude it. So here are some of the links. This PowerPoint will be up on Canvas. Um, so feel free to watch these if you haven't already. But anyways, we're learning about the Fed, and monetary policy is the policy that the Fed enacts to help the economy. And you'll hopefully have watched this video as well, which asks the question, what are the five reasons why the Fed was created? And so here they are. One, to stop competition from newer banks in the West, because it came about during that westward expansion in American history. Two, to obtain a franchise to create money out of nothing for the purpose of lending. Three, to get control of all reserves of other banks so that reckless banks wouldn't be overrun, to try and make things safer. Four, to shift the losses from banks to the taxpayers, so there'd be bailouts. So, for example, right now, the Fed is helping out companies, big companies, during a big recession, depression we're experiencing. And so that's what they would say. And then five, convince Congress that the purpose was to protect the public. So the video you watched earlier talks about the creature from Jekyll Island, and it talks about how the Fed was actually created by some bankers and how they convinced Congress that they needed to protect the public. And so at the end of this video, I want you to think through, um, is the Fed the way it is currently good? And so we'll explain more as we go. Now, some would say the Fed is the most powerful institution of all. The chair of the Federal Reserve is more powerful than the president, some would say. And here's why. So this is the measure of the economy. This is a graph, and these are the interest rates. And you may be able to see it here. These little gray rectangles are supposed to represent recessions in American history. And if you notice, the interest rates of the Fed are going up and then crash, going up and then a recession, going up and then a recession, going up, recession. And so every time it's going up, there's recessions, almost every single time. Here's one, it's kind of an anomaly. Here's one, it goes up, recession. 2008, up, recession. And so some would say that the Fed has more control of the economy, and it's because of the Fed that we have recessions and depressions. And so that's it's an interesting concept. I'm not sure if I agree with it, but either way, I want you guys to kind of think through for yourself: is the Fed really a good thing or a bad thing? And I've already been trying to make you think that through. Well, last week when I was asking you, is it constitutional or not? Now, let's talk about how it's set up. There are 12 Federal Reserve banks and 12 Federal Reserve districts. You can see here on the map how they're mapped out. And interestingly enough, there's a lot more districts on the East Coast, and that there's a lot more districts on the East Coast because the way the Fed was originally set up was so that the bankers in the East Coast would be able to control the banks in the West, because we were doing westward expansion during that time, and they were afraid of the San Francisco area banks becoming as powerful as the Eastern Coast banks. And so, anyways, the districts are still the way they are today, and the New York Fed is very special because J.P. Morgan and the Rockefellers were from that area. And so we'll talk more about that as we go on here. Now, the Federal Reserve Bank is controlled by the Board of Governors. There's 7 members of the Board of Governors. So here they are. They're all part of the Board of Governors. And of the 7 members, the president chooses the chairperson. So the chairperson is the president, so to speak, of the Federal Reserve. And they choose the chairperson and the vice chairperson. So there's your vice chairperson. Did you see it? The vice chairperson. One more time. The vice chairperson. There. Anyways, so all of them have 4-year terms and can be reappointed by the president. And so this is the only way in which the government of the United States has control currently over the Federal Reserve. Besides the president appointing who's on the Board of Governors, that's it. We don't control. It's not like the United States can say, hey, we need to raise the interest rates. We need to lower the interest rates. The Federal Reserve does that without the government deciding. It's completely being controlled by these Board of Governors, and they don't have to do what the president wants them to do because the president cannot fire them. He can appoint them, but once they're appointed, they do their own thing. They're not. They cannot be fired by the president. And so a lot of people let's call this a quasi-government institution because it's sort of part of the government, but it's not exactly. The government created it, Congress created it, but it's not being controlled by Congress currently. And so it's kind of a secretive group, somewhat, some would say. So anyways, the current Board of Governors are these 5 people here. You might say to yourself, Mr. Hansen, I thought there were 7. You're right. There are 7 that are supposed to be, but because every time one of these people has to come on board on the Board of Governors, they have to be appointed by the president and approved by Congress. And so Congress and the president, there's lots of politics involved and who gets appointed. And so it's politically hard to get all 7 people in at the same, get a whole full of 7 in there. So anyways, with that being said, Jerome Powell has been appointed by President Trump. And this is the current 5 members of the Board of Governors. And so there has not been 7 for a long time on the Board of Governors. It's been just 5. Jerome Powell was the vice chair last time under Janet Yellen, under President Obama. So anyways, this guy has a lot of power, Jerome Powell. Now, he's not the only person who has control. The Board of Governors aren't the only people who have control. There's also the bank presidents. So right here, these are the 5. This is under I'm blanking on his name. Anyways, this is one of the previous Board of Governors, and then in the back around here are the 12 regional bank presidents. And interestingly enough, Janet Yellen is one of the bank presidents who later becomes the chair of the Board of Governors. And Bernanke, Fred Bernanke, was one of the other previous chairs of the Federal Reserve. So anyways, the 12 regional bank presidents, why are they important? Well, again, because they're potentially likely to be appointed into the Board of Governors, but because they are part of the banks that follow through with the Federal Reserve policies, and they are part of the Federal Open Market Committee. And so what's that? Well, this is the part of the Federal Reserve that makes decisions about what should happen to interest rates, whether they should go up or down. And so there's 12 members. There's 7 Board of Governors. Currently there's 5. There's 1, which is the president of the New York Fed. And why is the New York Fed president always get to be on, and the other presidents only get to be on a rotating basis for a 1-year term? Well, because the New York Fed was where, remember, J.P. Morgan and Rockefeller and those other people who created the Fed in the first place were living, and they were the presidents of the New York area. And so it was a way to keep them in power um, um, almost forever. And so anyway, so this so one president of the New York Fed, and then the other 12 banks. There's four of the bank presidents who get to be on the board on the Federal Open Market Committee, and they get to be on there on a rotating basis for a 1-year term. So what do they do? Well, there's the let me just show you a little map here, a little graph. You got the Board of Governors on top, got your 12 Federal Reserve Bank presidents. They all help control the Federal Open Market Committee, and this directly affects commercial banks and thrift institutions. So commercial banks would be, big commercial banks like, what's it called? Um, Wells Fargo, Bank of America. These are all commercial banks. And thrift institutions would be like credit unions, most of what you're familiar with. So Tobacco, Dutrac, things like that. These are credit unions. But they control both of these things. And of course, they ultimately affect us, the households, the businesses of America. And and so they affect things by changing the interest rates. And so I'll talk more about the interest rates in just a second. So what does the Federal Reserve do? Well, they regulate the banks and the reserves. They loan banks money. So when they say regulate banks, they make sure the banks are keeping a certain amount of money in their vaults. So they're like the police officers of the banks. So every bank's supposed to have some money in their vault. So when you and I go to the bank and we say, hey, I need some cash, they say, okay, here's your cash. If a bank had their own, could do their own thing, they might make hardly any money in the vault. They might say, oh, sorry, you have to come back tomorrow, I'll give you your cash. But the Federal Reserve says, no, you have to have this percent of all the money you have in checking from everyone else who's put money in. You have to keep at least a certain percent in your vault, and then the rest you can go loan out and give to other people. So let me ask this question: what percent do you think the average bank they receive $100? What percent do you think they loan out, and what percent do they keep in their vault? Go ahead, give a guess right now. What percent do you think they keep in their vault? It depends on the bank, how big the bank is, but in general, less than 1% is required. So isn't that crazy to think they have that little money in the vault? And so this is why they have to have the police come and check, without the actual police, the Federal Reserves has to come and check on the banks to make sure they're being honest. And so why do I have this random person here? Well, this is my uncle, Larry Haddix. He works for the Office of Comptrollers, and he is part of in a sense, he's under the Fed, which is part of regulating and making sure the banks are following the rules. So he might go on, in the past, he would go and audit banks and things like that to make sure they were saying what was on the books was actually in their vaults and things like that. And so, so that's one part of what the Federal Reserve does. The other part of what it does is it loans banks money. So let's say at the end of the day, banks don't have enough money in their vaults. They need, because they have to have at least 1% or whatever in their vault. So they might call up some other banks, say, hey, can we borrow some money from you? Can we borrow some money from you? And if they can't get money from the banks around, they could call up the Federal Reserve and say, hey, we really need some money right now. Can we borrow some money? And so then the Federal Reserve will loan money to these banks. And so that's one thing they do as well. The third thing they do is they help the economy to have good inflation and little unemployment. And so they don't want inflation to get too high, and they don't want unemployment to get too low. They want to try and have a happy medium. So they're going to try and do certain policies to try and help the economy. So for example, if inflation gets bad, The Federal Reserve could say, hey, banks, you have to have a lot of money in your vaults from now on. Instead of 1%, you have to have 10% in your vaults. And that way it forces the money out of the economy into the bank vaults where no one else can have access to them in a sense. And that's a way of bringing down inflation. They could also do things to, if there's a lot high unemployment, they want to lower unemployment. They might spend a bunch of money. They might buy up a bunch of things and put money into banks. The banks will loan them out to other people. And so they'll buy bonds and other securities from banks to try and make sure there's lots of money in banks so that banks can loan the money out. And so currently with our depression, what is the Federal Reserve doing? They're lowering interest rates like crazy to try and make sure unemployment will go down, because unemployment has been jacking up because of this COVID stuff. So that's what the Federal Reserve does. So which would be better? Would you rather have a central bank with significant independence or a central bank run by Congress? This is a tough question. I want you to try and answer this on our discussion for the week. But let me help you think through this just a little bit. The Zimbabwe is a country in which their central bank has been run by their government, by their Congress. And so this is an actual bill in Zimbabwe, the $100 trillion bill. If you hold this piece of paper, you are a multi-trillionaire. Sounds cool. But in reality, you go to Zimbabwe, you try and spend anything, try and buy something with this, you couldn't buy anything with it because their government had just printed so much money that they had super crazy high inflation, and they had a horrible economy as a result. So that's a potential negative of a central bank run by Congress. Now, we do not have a central bank run by Congress. Although, does our government spend a lot of money? Sure. Would they spend a lot more, like Zimbabwe maybe, if they were in control of the central bank? I don't know. That's for you to figure out. But of course, we have a central bank with significant independence, and of course, why do I have this picture of the Illuminati, or the symbol for the Illuminati that a lot of people think? I have this picture there because a lot of people are, the Fed acts in secrecy, as they can't always explain what they're doing with their money, because then it would be like a conflict of interest with their the customers they're giving out loans to and things like that. And so a lot of people don't like the secrecy behind our current Federal Reserve. They don't like that it was founded by J.P. Morgan and the Rockefellers, and how that it maybe was created with some selfish motivation. And so there's these two negatives. And so some people say we should go to a central bank run by Congress. Some say we should keep our central bank with significant independence. Some people think we should have something else. We should have Bitcoin or something else. Maybe we can talk about Bitcoin another day. Or maybe you can talk about it in the discussions. But either way, I want you to think about and answer in the discussions today. Should we, as a country, have a Federal Reserve that is more significantly independent or run by Congress? All right, I hope you're having a good day. Staying safe. Peace.